So the next question really it's about the sort of practical, a practical question about the sort of barriers to expanding open finance into the pensions and wealth markets. Now, unlike bank products, which are relatively simple, pensions can be quite a headache, and we know that because there's a lot of complexity in pension products. There's lots of different types of products, and the market isn't digitized. We've got accounts that are sitting in boxes, still have paper records for. So these are presenting big issues for a move to get all that information into a form that will be accessible to customers. So I think I'll put the first question to Ross. If you could just pinpoint the big sort of legal, the barriers you think to open finance really rolling out into pensions and wealth.
I think the barriers are it's a big question. I mean, the first thought on this is the open banking's barriers were sort of helped through the barricades, shall we say, by legislation pushing that forward. And interestingly, when we look at things like pensions dashboard, there's a recent poll, there's 200,000 signatures of people requested that to happen. So you've got one starting from a position of regulatory change or government-led decision-making being pushed through quickly, and another one which has got the consumer saying, we want this, maybe not going through as quickly. Now, so the barriers, as far as I can see, must be sort of organisational, because regulatory challenges have always been there, and I assume will be accelerated in terms of how we get through them as a result of things of COVID-19. But I would have thought that the main challenge is going to be organisational. I suppose another challenge might just be in terms of understanding that in order to get to a position of open finance, there's a whole problem of what do we do with that customer data? And that's maybe an open identity challenge, a federated identity challenge that needs to be addressed along with this. And then lastly on it, I think we kind of need to recognise the strengths and weaknesses of each sector. You know, banking is very different from wealth and pensions. And as Daniel's pointed out, wealth and pensions are different things. And then we've got investments and savings, and then we've got assets, and then we've got credit. So there's almost a need to get to a position of a personal balance sheet. What the elements of that are required, and how do they all work together in some sort of synergistic fashion to achieve ultimately putting the customer at the centre of this, right? Because that's where it all started. So in summary, organisational.
Thanks very much, Ross. I'd like to address Sam. Sam, you've been working on the pensions dashboard project, which is really trying to get things moving in terms of getting a system for millions of people in this country to see their pension pots all in one place. Sam, I just want to know, with hundreds of pension providers out there, we're not just talking about 9 banks that open banking sort of dealt with, we're talking about hundreds of companies. And how big a challenge is it to get all of that data into a form that is usable?
Well, I think it's probably similar in the challenge that we have with open banking, because the CMA9, which represented about 80% of the current account market, were targeted first with the PSD2 legislation in the UK, but it didn't exclude, the PSD2 legislation has not excluded the remaining 20%, which had to follow on, after the CMA9, kicked off. So it's very similar to in the pensions world. There are 12 main pension providers that cover 80% of pensions in the UK. So clearly, the staging and prioritization of data and I guess the effort that will go into try and getting that up and running is something that the pensions dashboard is looking at. But fundamentally, you can't have legislation where an employer is legislated to actually contribute to people's pensions, and I, as an employee, are also having by law to contribute to my pension. And then when I get to retirement, have no way of knowing what money has gone where and where it is for me to draw down on my retirement. I mean, that isn't something that we can do. So going back to these unclaimed pots that Dan was speaking about before, that is just not sustainable. So it's kind of it would be a criminal act for us to do that. So it's non-negotiable, the pension dashboard. And you're right, some of the companies are going to struggle. I heard of one the other day where actually the records were burnt in a fire, so they don't exist. So there are challenges without doubt in terms of getting this, but let's be clear, 80% of people's pensions are covered by 12 providers.
Okay, thanks very much, Sam. I'd like to put a question to Dan now, specifically around governance issues. I mean, pension products are not quite like bank accounts. There are sort of things attached to them which might mean that someone is better off keeping that pension with the existing provider rather than moving it somewhere else. For example, the charges, there might be a guarantee on it. So the question really is, how do you make the market work well for consumers when pensions really are tricky products?
Thanks, Josephine. I couldn't agree more as well when you talk about a pension. It's probably the most unnecessarily complex thing going. And decade after decade, they've just added new spins to pensions, new variations on them. As Sam's mentioned, we've now got workplace pensions, which now follow you or don't follow you around. But, on average, an employer moves every 3 years or so. So by the end of somebody reaching retirement, the situation Sam's talking about there, they could have 5 to 10 different workplace schemes dotted around as well, and no ability to join them up. I couldn't agree more with you as well that giving clients the ability to freely switch a pension around using kind of open architecture could be really dangerous. You could unravel tons of legislation. You could unravel some really good financial advice given at the point of sale as well. I think you could go a lot deeper. This is a subject for a whole other day. And really one of the things we lobby government about is just about bringing one simple product out, almost doing away with pensions and just one simple investment vehicle for clients. Same tax treatment throughout, same kind of maximum or minimum savings amounts in there. And if you just cut away all of that, life would be nirvana, but that's real wishful thinking out there. I think just to kind of, I suppose, endorse what Ross is saying and Sam as well. I think the only way we're going to overcome the barrier, the only reason banks did open banking was because they were compelled to. They didn't do it as a charity, they did it because the law said so. As Sam said, 80% of pension assets sit with 12 of them. Just compel them to do it. There is a vested interest, I'll not be too controversial today, about dormant pensions or unserviced pensions out there, which are either in high charging or underperforming product out there as well. So it could be old-fashioned pensions, as Sam said, they could even be burned paper files now. They could be in very expensive legacy funds there as well. So the UK consumer is losing money right now in poorly performing products. And make no bones about that, some of the 12 organisations which Sam mentioned there, they make a lot of money from that consumer apathy.
This is once again a case of aligning incentives, and those incentives are consumers, customers, with all the different, in this case, pension providers or the broader extent of financial institutions, and they of course they have different features. Like some are established, some others are challengers, and so. You are trying to increase competition, and of course that creates a number of problems. Like we just said, that this is an industry that is highly concentrated into fewer institutions. They have fewer incentive to actually start this kind of innovation. So we're going back to very similar problem we had with open banking. How do we design those incentives? And I think we can do probably slightly better than what we have done with open banking. Open banking was very regulatory heavy. So you have seen a regulator, the Treasury, stepping in, mandating, organizing, and that created some shortcoming into the actual deliverables, like the products that bank build are probably 80% there. They are missing very valuable features. And so I think we need to create a slightly different framework this time around. We need to have the regulator to ignite the process and push the market into that direction, but we need to leave it open, a little bit of space also for business model innovation. We need to realign incentives. We need to make sure that everyone has also a financial incentive into building open finance infrastructure this time around. And so I think like also the regulator needs to get a little bit more, I would say, an approach that is more sensible toward testing first and maybe regulating a little bit after, and letting the market organize by themselves under their oversight. I think there must be struck a balance between those two forces, like a commercial element and a regulatory oversight. Still, if we look at open banking, that may be like a more narrow focus within open finance, like those shortcomings are quite visible. I think about, we are still missing an identity product in this space. Your bank data is now portable, but your identity, it's not portable yet. And so what we can do in that direction? When we opened up the bank account and payments from your bank account, there are a number of use cases that are out there. For instance, like helping consumers saving money in a very recurring fashion, very contextual fashion, that they are being left out. So we need a form of variable recurring payment. And again, we need to have the regulator creating that sort of master framework where also banks and financial institutions can also benefit more directly from this kind of innovation.